So since the semester started, we have talked about uh, currency, specifically the euro. We have talked about how paper currency took birth in the European area. We talked about what makes an optimum currency area that can have a single currency. We also talked about whether European Union or the Eurozone is an optimum currency area. And then finally, um, in the previous chapter, chapter 16, we spoke about the European Monetary Union, um, and how it has impacted the euro area. We're going to skip chapter 17 because it talks about fiscal policy, and so far, European Union does not have unified fiscal policy. It only has divergent or localized fiscal policy where each country can make their own spending decisions and taxing decisions. Um, so we'll move on to chapter 18, and I finish the class with chapter 19 in the interest of time. But in chapter 18, now that we've established that euro is the currency prevalent in the European Union, let's talk about its role in the financial markets. We begin this discussion by talking about um, what are the functions of financial markets. Okay, the first function of financial market is intermediation, and this function is very standard um, as it pertains to functions of a market for goods and services as well. Specifically, what I'm trying to say is in the market for goods and services, the buyer does not necessarily have to go find a seller, right? And vice versa. The seller doesn't have to go find a buyer either. What ends up happening is, let's say you produce, I don't, if you, let's say you produce hamburgers and you want to sell those to people. Well, you don't have to sell them directly to people. You can go to a grocery store, sell your burgers to the grocery store, and then buyers who desire to buy burgers can go to that grocery store and pick it up whenever they feel like. So that's the role of intermediation in the market for goods and services. Identical role is played by financial markets um, um, as well. So specifically, savers and borrowers do not need to meet face to face. Savers simply deposit their excess money in the banks and other financial institutions, which turn around and lend the money to borrowers. Right. So intermediation is the first function of financial markets. The second function of financial market is maturity transformation. Well, what does maturity transformation mean? So maturity transformation specifically means um, you may have, as a saver, you may not need the money for, say, X amount of time in the near future, say maybe 2 years or 5 years. Um, the borrower, on the other hand, may want to buy a home, and the home loan is generally for 30 years in the US. So how does the bank then turn around and transform your money, which you want to give it to the bank only for 2 or 3 years, into a 30-year loan? Well, what ends up happening is it takes your money that you want to give it to the bank, you want to save it at the bank at 2 or 3 years, and it lends it for 30 years to the borrower, hoping that 2 or 3 years later, when you show up to the bank asking for your money, somebody else may have come back to the bank and said, hey, I'd like to save money for another 2 or 3 years. So the bank would just turn around and give that money to you while the borrower keeps slowly and steadily making payments towards his 30-year loan. So maturity transformation is an interesting property of financial market that does not translate well in the market for goods and services. The third and the final property of financial markets is risk taking and diversification. We know that every single financial transaction is pretty risky, right? Especially loans. Loans are very risky because the borrower can simply not pay. Even if the borrower has the willingness to pay, he may not have the ability to pay because he or she may lose the job, And in some instances, borrowers may not even have the willingness to pay. So loans are very, very unsafe, relatively speaking. And on the other hand, deposits are very secure, right? Because in developed countries, um, um, most deposits are secured by a deposit insurance scheme. In the U.S., it's provided by the Federal Deposit Insurance Corporation and banks, and at credit unions, it's provided by the National Credit Union Administration. So what does that mean? Well, if the bank goes out of business or if the credit union goes out of business, you are made whole. You'll never lose a dollar in the United States. And that makes savings especially extremely secure. The most secure form of um, um, quote unquote investment is a savings account, right? Uh, so the question is, if you're a saver and you want to earn some money on the money that you don't need today, in other words, you want to earn some money on savings without taking too much risk, financial markets play a nice role of taking that risk on your behalf, and they guarantee that if the borrower does not pay the money back, you'll still get your money. How does that happen? Well, um, it happens because of diversification. Specifically, the bank is saying, look, I'm going to work in volume. I'm going to have hundreds of savers and hundreds of borrowers. And even if one or two borrowers don't pay me back, in the grand scheme of things, I'm going to be okay and I'm going to be able to cover all the savers because I charge a slight premium in terms of interest to the borrower, which then um, allows me to eat the cost of a couple of borrowers not paying. This would be simple. This would be similar to, let's say, a store buying tomatoes. Well, it doesn't really know how many tomatoes it's going to sell, yet it buys, let's say, 100 pounds of tomatoes. Well, if it does not sell 100 pounds and it sells only, say, 90 pounds, it has to eat the cost of those 10 pounds of tomatoes because they're going to rot. They're not going to live forever. So the idea is the grocery store is hopefully going to charge enough money to sell the tomatoes that it is easily able to eat the cost of those tomatoes as well. So that way they don't have they don't lose money, and buyers who want to buy smaller amounts of tomatoes are able to buy smaller amount of tomatoes. So banks do something similar, right? Is that they lend to too many people. A big volume, and they get savings from big volume of consumers, and then they make a margin in the interest, which allows them to eat the cost associated with borrowers not paying. These are also called, in banking lingo, these are called non-performing assets. These are the assets where the borrowers have stopped paying. Anyway, I digress. So those are the three main functions of financial markets. Let's talk about different types of financial institutions and markets. And so we alluded to the first type of financial institution, which is banks, while discussing functions of financial markets. Basically, this is going to sound very interesting, but there's no universal definition for what a bank is. But in the most commonly accepted definition for what a bank is a bank is a place that accepts deposits. Okay, that accepts deposits. Now, normally, most banks turn around and use that money to lend to borrowers, but that's what essentially a bank is. On the other hand, if you think about investment bank, well, investment bank does not really accept deposits, but they still manage a portfolio of money, right? They still manage portfolio of money that are not necessarily deposits. The second type of financial institution is a funds management company. So, a funds management company, as the name suggests, is not necessarily a bank. Does not deal directly face to face with an individual investor, but instead has a fund and invites investors to whoever wants to invest in those funds, right? So they don't deal with individuals. Instead, they offer wholesale services to banks and insurance companies, right? So they instead take the money from, say, for example, a Bank of America, and say, look, we'll invest it on your behalf, and make some money for you, and in exchange, we want a portion of the returns in terms of fees. So that's what a funds management company does. Does not deal with individuals. Finally, insurance companies. A lot of people neglect insurance companies and their role in financial markets. but they're probably some of the most important and absolutely voluminous um, uh, financial institutions in the financial markets. They probably play a role that is equal to or bigger than traditional banks, primarily because if you think about your auto insurance, say if it's with Geico, or your life insurance, say if it is with MetLife, what do you think happens to all those premiums that you pay each month, each every 6 months, or every year? Clearly, they're not turning around and giving away all of the premium as losses on or policy claims, right? Like, it's not like everybody is having car accidents, are getting into car accidents, and Geico has to pay out uh, um, to the insured, right? So what ends up happening is that it collects way more money than it actually gives out in payouts to the insured, and instead it uses all of that money to invest in other companies, to lend to other companies. And the greatest example of this is the owner of Geico Insurance Company, which is Berkshire Hathaway. Um, Berkshire Hathaway's chairman and CEO is known across the world. Warren Buffett is known across the world to make some very smart investment decisions. So that's what insurance companies do. They play a very important role in the financial markets as well. Finally, we talk about the market itself. So when we say financial markets, what are the financial markets? Well, there are two pieces to it. Financial markets are markets where you could get money by selling ownership in your company. So that'd be securities, right? Like, you sell stocks and people will buy your stocks, and then that's how you'd get money. The second way to get money is to buy and sell uh, bonds. You issue debt, people buy your debt, and then slowly and steadily you pay your debt back with some interest, just like a loan, except at a commercial level. So, bonds and debt securities are generally issued by both investors, or sorry, I mean both by firms and by governments for a specific amount of time, which is also known as maturity, and a predefined interest rate. Okay, and a predefined interest rate. Of course, on the other hand, stocks ownership of stocks give you no entitlement to interest or uh, to dividends. Dividends are not guaranteed, and so you may own a stock and you may never earn any money on it in terms of dividends or um, other advantages such as stock splits and stuff like that. So, um, so those are basically the types of financial institutions and markets, which would be banks, funds, insurance companies, and financial markets for stocks and bonds. Let's talk about the characteristics of financial markets, and we have alluded to this as well a little bit a few seconds ago. But the first piece is scale economies. None of this will function if a bank was not accepting deposits from hundreds and thousands of customers and turning around and lending it to hundreds of thousands of customers. The only reason why financial markets work and banks work is because it's able, as I mentioned before, it works on scale. And in doing so, the cost to originate, the cost to identify the borrower's ability to repay a loan is significantly smaller for a bank than it is for a normal person. Can you imagine? You had extra money, say 20, $30,000 that you didn't want for the next 2 or 3 years, and you want to lend it out. You tell all your friends that you have this extra money that you're willing to lend out for uh, you're willing to lend out for 2 or 3 years, and then your friends turn around and ask you, well, what's in it for you? What's the interest rate you're going to charge? You're going to say, well, it depends. It depends on your risk profile, and it depends on your likelihood to pay me back. So then the friend is going to be like, well, how are you going to evaluate that? Clearly, if you ask me, then I'm going to, of course, tell you that I'm always going to pay you back. That's what all borrowers say. So you're going to have to pick up the phone and verify with his employer what he's earning, how long he's been employed, how long he's expected to be employed, is he a good employee, so on and so forth. You then need to do that with the previous employer. Why was he fired? Why did he leave the company? Was he not, if he wasn't fired, did he voluntarily leave? Uh, and then you're going to also have to ask his prior, um, uh, uh, the people that lent him money previously, and ask them whether he has historically paid all of his loans back. All of these things take time and cost a ton. And not to mention that you may just never know. None of this may be accurate. The people you may be calling may be fibbing. So banks are really, really good at doing this, at sniffing out the borrower's ability to pay them back. Why? Because they just do it all the time. That's their business. This is what they do: is to take the money from the saver and then give it to the borrower and make sure that the borrower pays back, right? Um, so another thing is also there's many barriers in today's global world. Imagine you did a study abroad program, right? Or maybe you did your master's degree at London School of Economics, right? Well, you're gonna have to convert your currencies in pounds. So let's say you borrow money from Bank of America. Bank of America is gonna have to figure out how to give you that money in pounds, and it's also not only that, going to figure out how much money you may need for the next semester 6 months from now in terms of US dollars. So all of these complex calculations, these banks are extremely good at doing. And they're extremely good at doing because they do it all the time. You think about banks like Wells Fargo or JP Morgan Chase, these are like nearly 100 years or over 100-year-old banks, and this is all they've been doing for 100 years. Okay? The second characteristic of financial market, which I find very interesting and it's unique only to financial markets, does not exist in goods and services market, is the network. Okay, it's the network effect. And so, what does the network mean? Let's say you have an account with Bank of America, and you inherited like $50,000. You know you don't want that money right now because you're a full time student, but you think that you may use that to put a down payment upon graduating on a house. So you go to Bank of America and you say, I want to deposit $50,000 for 2 years, and I'm going to remove it after 2 years to buy a house when I graduate. What if Bank of America then says, well, the problem is that sounds all well and good, but I don't have anybody who wants to borrow $50,000, right? And the transaction ends pretty much there if it was the market for goods and services. In other words, if you went to the grocery store and you said that, for example, you said that you had all these tomatoes to sell. Well, the grocery store says that, well, we just don't sell tomatoes. We've tried it in the past, and our customers don't like tomatoes. So sorry, too bad, we can't buy your tomatoes. That's not quite how it works in financial markets. Even if Bank of America is not able to figure out what it's going to do with your money, it knows that JP Morgan Chase may have a borrower that can use your money. So it's going to lend your money to another bank. And then that bank is going to turn around and lend that money to their own localized or their native borrower. Um, so this is a very important component of financial markets, and this is part of the reason why, if you ever think about why these banks were bailed out during the financial crisis, uh, the important answer to that question is because of exactly this. Is because if you if is that because banks do dealings with one another at such complex and frequent level that if one bank fails, pretty much everybody else would fail as well because everybody owes everybody else money, right? So network is one other characteristic of um, financial market. The third, once again, an interesting characteristic of financial market is asymmetric information. And what does that mean? Well, we have alluded to this a second ago. If you were to go lend your money to your friend is of course going to say that he's going to pay you back. But his ability and willingness to pay back the loan is only known to him. And he's never going to reveal that to you, the lender. Because if he has ill intentions, especially if he has ill intentions, he's going to know that if he reveals this information to you, then you're never going to lend him money. So the fundamental characteristics of financial activities is that the borrower always has an upper hand about his or her own riskiness than the lender, right? And as a result, the lender can just say, you know what, I'm not going to lend money to anybody because I just can't ever get to find out anything about the borrower, or I'm just going to charge a ridiculously high interest rate both to good people and to bad people, people who have no ill intentions, and I know they're going to pay me the money back, uh, and to people who I don't trust that they'll pay me back, or I trust that they'll pay me back, but they intend not to pay me back, right? Well, the problem is this brings the financial market to a standstill. In that, uh, if if the banks choose to charge ridiculously high interest rates, well, then what's going to happen to me, the good borrower? Well, if I'm the good borrower and I have full intention to pay you back, the bank back, I'm just gonna say, well, this just makes no sense. The interest rate is so high that I might as well not borrow. And then in doing so, the market is just left with lousy borrowers who have no intention to to pay the banks back, right? So in the grand scheme of things, this is what once again happened with during the financial markets, specifically at a time after Lehman Brothers collapsed. Every bank started wondering whether every other bank that it was going to lend money to is trustworthy, and it instead ceased lending money to pretty much everybody and said, we don't trust anybody. We're not going to lend money to anybody because we just don't know if they're going to turn around tomorrow morning and just fail like Lehman Brothers, because we just didn't get our money back from Lehman Brothers. What are the chances we're going to not get money from other banks as well? So those are the three main characteristics of financial markets that make them extremely unique. Scale economies is something that you see in market for goods and services as well, but networks and asymmetric information is unique to financial markets only. Okay. So section 18.2 talks about the effects of monetary union on various components of financial markets. But let's start with a little bit of history. Um, to be honest, it's a summary of the history that we have already discussed with regards to capital market integration. Specifically, we discussed that in the early 1960s, the European Commission did promote capital market integration for the namesake, but we learned that there were adequate loopholes in their promotion of liberalization that pretty much kept the financial markets from becoming integrated. And then in 1986, with the passage of the Single European Act, um, it established principles. It established the principle that all forms of assets should be allowed to move freely inside the EU. But the Single European Act was also marred by the fact that in 1986 we did not have a universal currency. You didn't have a common currency, specifically the euro. So yes, in theory they wanted liberalization, but in practice it was not possible with separate currencies. Article 56 of the Maastricht Treaty, on the other hand, got the ball rolling, and said that all national restrictions on free movement of capital were pretty much illegal, except, of course, in very specific cases of law enforcement or national security. And those law enforcement and national security related restrictions are also applicable in the US. For example, if you're a drug trafficker, you can't just go around investing money out of state, even though interstate commerce is fully free in the United States. Similarly, interstate capital investment is also free in the EU, except in certain cases. Okay. And then, of course, in and of itself, Article 56 wouldn't really help But what really made it so powerful is the fact that Maastricht Treaty also paved way for adoption of euro in January 1st, 1999, and so it made it easy to invest in other European Union countries or other countries who have also adopted the euro. So here I have for you some data on um, the effect of single currency on banks. Specifically, now that you have single currency, is there an incentive for banks to? So we're right here. Is there an incentive for banks um, to now open branches in other European countries because they have the same currency? So what we're seeing is, if you look at, so how do you read the chart? In the blue bar is the number of MFI, is the money financial institutions. There are non-money financial institutions as well, but MFIs are pretty much essentially banks. So the blue bar shows the number of banks in each country, and you can't quite see the numbers. But the first three observations, the first three bars in the bottom, as you can see, belong to Germany. After that is Italy, and then the fourth country is France. The second to the last country is Spain. So as I mentioned, this was France, this is Italy, this is Germany, this is Portugal, Greece, and so on and so forth. But what I want you to pay attention at here is, if you look at it, since the financial crisis, which began after 2008, the number of banks overall, for example, in Germany, has gone down. But on the other hand, the number of foreign branches, which is indicated in yellow, have actually gone up. As you can see, from 104 to 112 is a direction upwards. You could see that's the case for more for other countries as well. In fact, if you look at France, the number of banks have pretty much declined by half in the last 10 years, as you could see here, from 2008 to 2018. But the number of foreign branches has nearly tripled in the same time. Is that true for all European countries? Not necessarily. Now, if you look at, for example, if you look at Italy, you could see not only the number of banks have gone down, but also the number of foreign branches have also gone down, right? The number of banks have gone down, and the number of foreign branches have also gone down. Look at Spain. Number of banks have absolutely gone down, but the number of foreign branches gone up. So there's not a consistent story in terms of the impact of the single currency on the banking system. So let's rewind a little bit and think about why this could happen, right? So before the adoption of euro, or before there was a single currency, it was pretty obvious. Different currencies made it very difficult to open banking facilities in different countries. The idea being, if you were a depositor and you had choice of depositing your money in at a bank in your own country, or at a bank in another European Union area, even before the single currency, the problem is not only do you have to compare the interest rates, as we discussed in the interest rate parity condition, which said that the difference between interest rates between two countries is explained by the expected exchange rates. Not only do you have to compare the interest rates, you also have to compare the expected exchange rates that would prevail at the end of the investment period. So the problem with this school of thought is, who wants to really do these many calculations? It's probably, if you're a small time depositor, it's probably easier for you to just go ahead and invest in your deposit the money in your own country. So that's part of the reason. That's part of what kept banking services segmented along national lines. Okay, so the second point is that customers also do not change banks easily. Even after euro was adopted, customers didn't really find an incentive to change banks. Well, there are many reasons. If you think about how you pay your student loan payments, or how you'll eventually pay your student loan payments, how you'd pay your mortgage, how you right now pay for your rent, or how you pay your tuition, or how you pay your credit card bills, or your car note, whatever the case may be, in most of these instances, your bank account is linked to all of these payments, in that you ask the lender to directly debit your bank account in the amount that is owed. So if you change your bank, whether you change it for another bank within the same country or even a foreign bank, it's just too inconvenient. There's not enough benefits for you to be convinced that this is what you should be doing. Okay. The third reason why bank services were segmented across national lines in the European Union despite the adoption of euro is because banks tend to develop personal relationships with their customers, primarily because they want to reduce information asymmetry. We touched on this a little bit earlier. Information asymmetry is what occurs when borrowers, by definition, have more information about their willingness and ability to repay the loan than the lenders. So banks try to minimize the information asymmetry by trying to build on personal relationships with their customers. And customers also value knowing their banks, knowing the tellers, knowing the people that represent their banks, as opposed to just walking into a branch where nobody knows them. Depositors tend to feel more comfortable with that. So in some ways, banking relationships are a little bit sticky. And with the adoption of euro, that doesn't really change the fact that, as I mentioned, banking relationships are a little bit sticky. The fourth point is the fact that proximity makes a lot of difference as well, in the sense that if you are doing business with the same bank for years because it's, say, I don't know, 2 blocks from where you live, and a new bank comes in, well, the new bank has to be equally convenient. The new bank has to open a branch 2 blocks from where you live, or a few blocks from where you live, to convince you to switch banks. But that requires huge investments, right? So it's not just you; it's targeting the entire country. So for a foreign bank to open shop in a new country, they can't just advertise in the newspaper saying, "Oh, we now accept your deposits and we are doing banking. We're offering banking services in your country." Instead, what has to happen is they have to open branches, slowly and steadily develop relationships with local depositors, and that's how they gain business. But all of this costs money. So that's another reason why banking has primarily remained segmented in along national lines. Finally, part of the unusual reason why banking has remained segmented along national lines is because of people's perception. And the perception, which also prevails in the US, is that if you open a bank account with a foreign bank, then maybe you don't get the deposit insurance, which in the US is provided by the FDIC for banks and NCUA for credit unions. This is a wrong perception. Basically, if you're a financial institution that accepts deposits in the US, then you're pretty much across the board blanket insured in the United States, no matter where the bank is from. There's pros and cons to it. Specifically, the benefit is that you get deposit insurance, but the cons is if you're a bank, you have to abide by the American rules, banking rules. So that perception, however, still persists, and that's part of the reason why people like to bank with the banks in their own country, right? Okay, so if we were to look at some of the data, then what we'd find is that the bank deposits increased over time during the period of great moderation from 2005 to 2008. So the euro was pretty much adopted in 1999. Then you had the dot-com crisis in 2001. But if you look at the period from after 2001-ish, specifically 2005, to right before the financial crisis, Eurozone households and corporations increased bank deposits substantially during this period, right? And so why did this happen? Among many other reasons, one of the reasons is because with the adoption of single currency and with even more integration in the Eurozone, a lot of people started feeling comfortable with buying real estate in other countries. Specifically, a lot of Brits and a lot of Germans bought real estate in south of Spain. in sleepy areas, or what used to be sleepy areas, like Murcia, which is which is in the south of Spain, um, on the same coast as Valencia. What ended up happening is there's this super big construction and development boom, and this was primarily to cater to eurozone citizens or retirees from colder countries like the UK and Germany. So a lot of the Germans started borrowing money from their banks to buy real estate in Spain, and so that part of the that is part of what explains increase in banking activities from 2005 to 2008. Another thing happened is that after adoption of euro, cross-border deposits and loans among banks also gained rapidly. But there's a problem with this in that the financial crisis caused a very sharp reversal in cross-border deposit and loans among banks because habits are hard to break, and people went back to their old habits of depositing less money in foreign branches and doing less business with foreign branches. One final thing which is interesting is yes, there's some back and forth going on between deposits and loans since the adoption of euro. But one thing is clear: since the adoption of euro, there is no cross-border mergers. So a lot of banks from 1999 when the euro was adopted to right before the financial crisis merged away or liquidated between 1999, as I said, 1999 and 2008. Specifically, there were 8320 banks on the eve of euro adoption, and in 2008 there were 5708 banks, 5,708 banks, and majority of the decline in the number of banks is explained by mergers and acquisitions. But most of these mergers and acquisitions happened within country and not across eurozone. So that was an interesting thing to learn as well. That while banks were liberated in banking activities, showed some sign of liberation in terms of loan and deposit from foreign countries within the eurozone. But you did not see that with the acquisition and merger data. Okay. Let's now talk about the impact of single currency on the bond market. So the interest rate parity principle says that basically, as I mentioned before, differences between interest rates in two countries are explained by, to a great extent, change in future exchange rates or expected change in exchange rates, and risk premium. Well, now that you have adopted euro, expected change in exchange rate is zero by definition. So then theoretically, the two interest rates between the two countries, if you assume that the risk premium is zero, then the two interest rates must be equal between two countries. That is what the interest rate parity principle says. And that is actually exactly what happened after the adoption of euro, right up to the financial crisis. Right when the financial, so we saw basically we started out with divergent interest rates between countries, but then when the financial crisis hit, right before the financial crisis, during the period of great moderation, there was a convergence in interest rates. And what that means is various European Union countries that have adopted the euro were able to borrow at pretty much the same low rate that, for example, fiscally savvy country like Germany could. So Greece could borrow at the same rate as Germans could. But then with the implosion of debt in the aftermath of the financial crisis, the rates became diverged once again, or decoupled once again, and now they're finally in 2020, what's 12 years after the crisis, they're sort of starting to converge one more time. Okay, and I think we have a chart to show this data. No, we don't. We don't have a chart to show this data. But I think your textbook has a chart to show this data, and we'll talk about that a little bit later. So we talked about the bond. We talked about the banks. We talked about the bond market. Let's talk about the stock market. So this is chart that is not in your textbook, but I was able to get it online from an article that European Central Bank publishes every year called Financial Market Integration in Europe. Um, and so this is where this comes from. I think this specifically comes from a 2018 publication. So here what we see is the blue curve is the uh, proportion of debt securities that are owned by countries that have adopted euro but that are not the home country. So in other words, if you're in Germany, what proportion of German debt, and by German debt I don't necessarily mean government debt, I mean government and corporate debt. What proportion of debt in Germany that is owed by the German government and owed by the German businesses is owned by other European nations that have adopted the euro. So that's cross-border debt security as a percentage of total security. So if you look at right before the financial crisis, the number was as high as, this is the blue line right here, the number was as high as, maybe this is better. The number was as high as about 34%, right? 34% of all debt in the European area was owned by other countries, and not the country that originated the debt. But if you look at the steep decline as a result of the financial crisis, it went down from as much as 35% to nearly 28%, and then it picked up, and then it went down again. So now it's at pretty much at an all-time low of 28%. So in that sense, the European, in that sense, adopting the euro and the European experiment has failed a little bit. Okay, but could you say the same with equities? Not really. If you look at the cross-border equity ownership as a percentage of total equity, you see that it started out at 17%, and now it's at as high as what is this, 20%, 21%, right? So there's a unfettered increase in security ownership versus in equity ownership versus debt ownership. Okay, so let's look at the impact of single currency on the stock market, right? So part of the challenge is stock markets are indeed characterized by strong home bias. And what do I mean by that? Well, we know that the third largest economy in the world today is Japan, and we know it has been a pretty big economy, pretty successful. But part of the reason why you and I don't go out and buy Japanese stocks, for example, is because we don't have the capacity to read their financial statements and make partly because they're in a different language, but also because we just don't know or are unaware of Japanese business practices. So in that sense, we are not going to invest in Japan, and this is true with European countries too. Imagine the United States of America was like United States of Europe, where you had 50 states speaking 50 different, or pretty much 50 different countries, 50 different languages, and you may then find it difficult to invest if you're in the East Coast, then to invest in California, and if you're in California, invest in the East Coast, which would be New York, partly because everybody speaks a different language and there's different business practices. So that's not true for the US, but it is true for the Germans, in that everybody does speak different languages, and it makes it very hard to invest in other countries. Okay? But the evidence, so when you take out individual retail investors like you and I, and if you were to look at investment funds, then what evidence shows, and your textbook has a chart on this, is that investment funds, on the other hand, are investing significantly more than they used to before the adoption of euro in non-home eurozone companies. So non-home eurozone companies are basically companies that are based in the eurozone that accept euro as their currency, but they don't. They're not based out of your country. They're based in a foreign country. Okay.
This has changed slightly, though. This has changed in the sense that the Eurozone crisis has made it difficult or made a slight reversal in investment funds investing in non-home Eurozone companies. There's a significant acceleration towards ownership of shares issued by the rest of the world. There may be some bias in this statement where there's a significant acceleration in investments in shares issued by the rest of the world, because primarily we are really talking about European companies or European investment funds investing in the U.S. And it's not like they're investing in every single country in the world. It's really two or three countries where the money is going instead, and that has to do with the fact that U.S. is significantly more robust economy than many of the European Union counterparts. So if you're a European, you're better off investing in the U.S. than probably in other countries such as Greece, Italy, and so on and so forth. Okay. One final thing is, if you think about it, with the adoption of euro, you would think that there would be something similar to like New York, something similar to New York, what New York is for U.S. in terms of the stock exchange, in terms of it being the financial capital of the world, or for example, London, in the sense that the entire eurozone would have one very well-known city that becomes the financial capital of eurozone. That hasn't quite happened in the stock market, in the stock markets, specifically because all countries tend to be more biased towards retaining their own stock markets, even though they would significantly benefit from pooling all of their stock markets and just essentially having one market, just like the US does, which would be, for example, the New York Stock Exchange. Um, but imagine each of the 50 states having their own stock markets. That would be pretty fragmented and pretty difficult to then transact, right? So Europe partly wants to keep, or individual countries in Europe partly want to keep their own stock markets because it brings in a sense of pride and prestige, and also it's a major economic activity. There's a lot of money to be earned if you had your own stock market, right? And the pride and prestige piece is very similar to airlines. Many countries, or pretty much all the countries, have their own airlines, partially because even if they don't make money, it's more about prestige. For example, South African Airways has never really made money, but it still runs because it's more about pride. Qatar Airways, Emirates of Dubai, and then you have Turkish Airlines, Air India, Air China, Air New Zealand, Air Canada, so on and so forth. So most countries have their own sort of airlines. They all started out as government-owned airlines, and eventually they were privatized. Okay, because it had to do more with the pride and prestige. Anyway, so that's the impact of single currency um, on the banking system, the bond market, and the stock market. Let's look at the overall impact. Okay, so the overall impact. Once again, this chart is not in your textbook, or it is in your textbook, but I have an updated chart up to 2019. The chart in the textbook ends, I think, in 2013, right here. So let me erase that. Maybe if I made this thicker. All right. So the chart in the textbook ends here, but this is an updated chart. Okay. So a couple of economists in the European Union, they put together some sort of composite indicator that tells us how integrated are the financial markets in the European Union. Okay, specifically, um, the yellow line is a price based indicator, and what it does is it aggregates 10 different smaller indicators for bonds, money, equity, and retail banking. This gets super complicated, super fast, but basically the yellow curve is measuring pricing differential in different countries. And on the left axis right here, 0 means not at all integrated, and 100 means fully integrated. Okay, so 0 means not at all integrated, 100 means fully integrated. So what we could see here is European Union started out as with the adoption of euro in 1999. Right here, you see that the integration activities were a little bit subdued for until 2003. Then you had the period of great moderation, and there's significant integration in the pricing differential. So, sorry, I should have probably discussed this a second ago. What the pricing differential specifically means is that they look at various financial services like cost to borrow, cost to raise money in the debt market, and cost to raise equity, so on and so forth. Retail banking, and they try and measure how different these prices are in different countries. And so as you go closer towards one, prices become identical, and as you go closer towards zero, there's significant differences and variances in prices. So that's what the yellow line shows, is that as it gets closer towards one, that means there's more integration. As a result of the financial crisis, however, there is significant decoupling immediately, and that decoupling kept going until 2013, where your textbook's chart ends. But we can continue, and we can see that there's reintegration, if you will, of at least the pricing differential within the European area. Okay, let's talk about the blue curve. The blue curve is a quantity-based composite aggregate that aggregates five indicators, excluding retail banking, the five indicators we mentioned a second ago. Basically, this looks at volume differential, right? So what this is, so the other side of the coin with price differential is volume differential. What does that mean? Well, it looks at the volume of activities, cross-border activities within these sort of financial services. So once again, zero means very little cross-border activities in terms of volume, and one means perfect cross-border activities. In other words, 100% of all activities happen cross-border, which is less feasible and very unlikely. But the point is, you want to get as close to one as possible. So you start out at 1999, when there was abolition of any sort of policy that would not allow for capital market integration. And then slowly and steadily, you saw a ton of integration in terms of quantities. There was some flattening throughout the financial crisis and some decline. And then there's pretty much a slow increase since the financial crisis, since the aftermath of financial crisis of 2013 onwards, in terms of quantity based financial integration, and specifically volume of financial activities. So the point is that financial crisis was a big hit on the financial integration motive of the European Union and of the adoption of euro, but slowly and steadily it's going in the right direction, and at the minimum all the pieces are in place for it to resume even deeper integration. Okay, so let's see. So as I mentioned, there was integration until during the period of great moderation until 2008, and after 2008, it has put temporary stop to financial globalization. Okay. Section 18.3 looks at the fragmentation in the banking system during the crisis. Let's start with the discussion on banks and the interbank market. And this is going to be an especially interesting discussion because this is how American banks were also bailed out. So it'd be a nice lesson that impacts both the European or Eurozone and the US. So usually commercial banks are in the business of granting loans and accepting deposits. And when I say commercial banks, there's only one type of bank, which is a traditional commercial bank that accepts your savings and then it gives out money as loans. So So one of the things happens, as I've discussed before in an example, is say you're a depositor and you out of nowhere you inherited $30,000 or whatever, and you go to your local bank and you say, "Here's $30,000 that I inherited. I'm going to deposit it in my bank account." Well, the bank has to do something with that money because why? Well, because it has to pay you some sort of savings interest rate. I mean, granted, these days, no bank pretty much pays any money to savers, but let's just say that there was some savings rate it had to pay to you. The only way it can pay you that savings rate is if they were to turn around and take your money and lend it to someone. Well, now comes a huge dilemma. The dilemma is at the exact same time, the bank would have wanted someone to walk in and ask for a $30,000 loan. Now, the chances of that in a specific city, in a specific branch, are very, very unlikely. Even at the national level, with the advent of computers, where you deposit your money in San Francisco and the bank already has somebody waiting in New York to borrow $30,000 at the exact same time, are also still very low. Even if that were to happen, one more thing has to happen, which is the time horizons have to meet. So you, as a student, you go to the bank and say, "Hey, look, I'm going to graduate in 3 years, and I'm going to use this $30,000 to buy a house." So the bank now knows that it needs to give you the money back in 3 years. The question is it going to find a borrower exactly for $30,000, and is it going to be able to is that borrower going to want the money exactly for 3 years? Once again, the chances of these things happening are very low, and even if that were to happen, then is the problem of making a determination of the borrower's ability and willingness to repay the loan back. So the even if there are many borrowers who would want $30,000 for 3 years, the question is, do you qualify? Are you credit worthy enough to borrow that money? So when you add all these variables, you'll quickly recognize that the business of banking, it works on volume. And not only does it work on volume, it works on the network component that we spoke about when we started this chapter. Specifically, banks, if they get the deposit that they don't know what to do with, then they're just going to turn around and they're going to deal with this imbalance with another bank. So maybe your bank doesn't have someone who wants to borrow $30,000 for 3 years, but some other bank does. So your bank turns around, takes your deposits, turns around, and lends that money to another bank in what's called an interbank market, right? And the interest rate on this loan, which is an overnight loan, so the other bank has to, by definition, return the money back to your bank within 24 hours, is called the federal funds rate, which is what the Federal Reserve governs. Okay. So this is how imbalances are taken care of in the normal banking world. It's true in the US, true in the Eurozone, true in pretty much any part of the world. Except in the summer of 2007, what ended up happening is because of financial crisis, many banks stopped lending money to other banks. So if your bank got that $30,000 in 2007, it would be like, you know what? I don't really trust the other bank, or for that matter, any bank, and I'm just not gonna I'm just not going to lend my money. And this was especially true. With if you were to look at interbank lending at two different groups of countries, and let's call one country distressed country and the other country non-distressed country, you will see that at the peak of financial crisis, which would be about here, summer of 2007, you'll see that, of course, there's a decline in interbank lending in both of these two groups of countries. Oh, I forgot to mention the distressed countries. Let's say the distressed countries are. So this would be Cyprus, Greece, Ireland, Italy, Portugal, Slovenia, and then Spain. These are the distressed countries. Okay. Cyprus, Greece, Ireland, Italy, Portugal. It should be probably not to confuse this with Poland. We'll say Portugal is PL instead of PO. And then Slovakia or Slovenia and Spain. So you look at the steep decline in interbank lending after the financial crisis. In fact, if you think about it, it has never really recovered. But even before the financial crisis, say in 2004, during the period of great moderation from 2004 to 2007. So this would be great moderation, right? Even during this period, there was a divergence in how banks lent money to each other within these two groups of market. And financial crisis made that even worse. If anything, you see there's some sort of convergence between the two groups of countries, and interbank lending has pretty much come to a standstill as of 2013. Okay. So basically, they stop lending to each other. Now, this is monumental because, as I mentioned before, if a bank doesn't have a partner bank that it can lend you $30,000 in deposits to, then what is it gonna do with that money? Not only what is it gonna do with that money, more importantly, how is it gonna pay you an interest on your savings deposit? So it has to figure out a way to deploy that money. If it is so, one could argue, well, a week from now, that person who wants $30,000 for 3 years shows up. Yes, but when you do that on volume, how is the bank going to pay that interest for that 1 week? And it eats into their profitability. So it's not a very profitable solution to just sit on money that's not deployed. Okay, so that was the first thing that happened between the banks and the interbank market as a result of the financial crisis. Now let's look at how the European Central Bank responded and the impact on basically lending money. Okay, so even though during the financial crisis the European Central Bank flushed the eurozone with cash, just like if you remember the bailouts from the Federal Reserve. The TARP funds and so on and so forth, essentially flushed the economy both in the US and the Eurozone with cash. But the challenge was there was monstrous fragmentation instead of integration within Europe, whereas in US there was integration in the sense that banks realized that they face different playing fields, okay, in these two different countries. So the way it works is usually for smaller loans, banks charge a higher interest rate because of information asymmetry. I know this sounds counterintuitive. Like, wouldn't the interest rate be higher for higher dollar amounts uh, there's more risk with losing more dollars? That's not necessarily true. Interest rates are usually higher for smaller dollar loans. One, because as far as capturing information is concerned, you have to understand that someone who wants to borrow $1 billion probably has very well designed financial statements, very reliable financial statements that a bank could trust before lending that money. Whereas someone who wants to borrow $300,000 to buy a house probably has his or her finances in disarray. They don't produce financial statements. They're not audited by independent auditors, and so on and so forth. So it's more difficult to originate a small loan than it is to originate a large loan, relatively speaking. Of course, a larger loan theoretically still poses a greater risk. But anyway, so one of the things that happened in the wake of the financial crisis is the risk premium between the small loan and large loan between these two groups of countries increased substantially. Let's look at the chart to the left. What it shows is from 2005 to 2013, the spread between small loan and large loan. So large loans are loans over $1 million, and small loans are loans under $1 million. And basically, you will see some spread, which makes sense, right? Because as I mentioned, larger loans are riskier. But in the aftermath of the financial crisis, and since then, the spreads have just gone out of control. So if you look at the overall euro area, which is the dark blue line, you see until the financial crisis, all three, the distressed area, the euro area, and the non-distressed area. So just to clarify, the euro area is made up of the distressed and the non-distressed area. So something like this, right? So the euro area is already made up of distressed and non-distressed area. And in an ideal world, if you are touting convergence as a benefit of a single currency, then you should see this. This is more desirable, right? This convergence up to 2007 is desirable. You want, no matter what country you're from, the spread between small and large loans is identical, right? In this case, it's about 100 basis points. It went down to 50 basis points, okay? But look at what happened in the aftermath of the financial crisis. In the aftermath of the financial crisis, distressed countries saw an increase in the spreads between large and small loans, and this is undesirable. So these are the distressed countries right here, and these are the non-distressed countries that kept going as if there was no financial crisis. Yes, the spreads increased, but not substantially. Here, there's almost a 50% increase in spread between prior to the financial crisis to the aftermath of the financial crisis. And it didn't stop there. The spreads continue to increase, and the gap continue to widen between the distressed and the non-distressed country. So that's one of the ways fragmentation was exposed in the aftermath of the financial crisis in the Eurozone area, despite adopting a single currency. Okay. The second thing to look at is loan applications. Now, this is a pretty fun chart on the right-hand side. It basically shows the proportion of loans that were rejected for various reasons. Or let me put it this way: the proportion of loans that were not taken out for various reasons. So the subtlety here is that if you're a borrower, you can either one, get rejected for a loan. Two, the cost of the loan is prohibitively high and you choose not to take it. Either way, the funds are not received by you, right? So that's what we're looking at. So on the left-hand side, if you look at the distressed countries, the proportion of loans that were rejected were pretty low prior to the financial crisis. This is about 10% of all loans were rejected because the lender didn't want to give you money. But if you look at what happened in the aftermath of the financial crisis, this looks like, so let me do this. So this looks like about 10%, right? This looks like, on the other hand, about 20% of the loans that were rejected in distressed countries. On the other hand, if you look at the non-distressed countries, barring this guy, the average is, so barring this bar, the average here really comes out to what? 7 to 10% loans were rejected. So as you can see, this is once again exposed fragmentation in the banking world in the aftermath of the financial crisis. All these little nuances are pretty important to think about, because the whole point of European Union and the whole point of Eurozone with its single currency is to integrate, in the sense that all of these issues, country-specific issues, sort of go away, and the European area becomes a truly single market, just like the United States of America. Okay. One other thing happened during the financial crisis is that if you think about depositors, as I mentioned before, are protected by deposit insurance provided by the deposit insuring agency in various countries. But in the financial crisis, a weird thing happened, is that Ireland, out of nowhere, decided that it's going to provide unlimited deposits, unlimited deposit insurance to an unlimited balance. So usually there's a cap. In the US, it used to be $100,000 before the financial crisis. Now it's $250,000. In the European Union too, it used to be 100,000 euros before the financial crisis. Now I'm not sure what it is. It could be £250,000. But either way, in the aftermath of financial crisis, Ireland said, well, what we are experiencing is a lot of people are losing faith in their banking system and they're withdrawing their deposits, which makes it very difficult for a bank to fulfill every depositor's claim. Because remember, we spoke about this. An average depositor deposits for a much shorter time, but an average borrower borrows for a much longer time, right? So go back to your $30,000 example. If I wanted to borrow money to buy a house over 30 years and you wanted to save $30,000 only for 3 years, well, there's a problem, right? Not everybody who wants their deposit back at the same time can get it. Anyway, so Ireland provided unlimited deposit insurance, and as a result, not every country's deposit insurance was considered identically safe. In other words, if I'm an Italian and I realize that Ireland, I'm in the European Union, and I realize that my bank is not providing unlimited insurance, but Ireland is, I might as well move my deposit in Ireland because then I'm guaranteed that I won't lose any money because European Union and Eurozone now allows for unlimited or free movement of unfettered movement of capital. So I can pretty much open a bank account in any European country. Anyway, as a result, what ended up happening is a lot of the deposits started moving away from distressed countries, like I mentioned, like Italy, into non-distressed country, which was especially made easier through single currency. A special side note is the country, a very small country of Cyprus, where there was a point where it was forced to establish limits on cash withdrawals, and it imposed capital controls, which once again goes against the grain and the intent of Eurozone and single currency. So those are two or three things that happen that expose fragmentation in the banking system in the aftermath of the financial crisis. Let's look at the bond market. Okay. So in most countries, what ends up happening is private issuers of bonds usually offer a higher interest rates. When I say private, it doesn't really mean like you and I. It means businesses offer a higher interest rate than their local government, and it makes intuitive sense because the government can always print money and repay their bond, so the risk is lower. Or, of course, the government can also charge higher taxes, lower spending, do whatever it takes to pay their bills, to pay their debt. But a company can't do that. So, for example, if you bought bonds in, say, I don't know, Verizon or something like that. Well, the Verizon cell phone company or cell phone service provider can't really print money. The only way it can pay you back your loan is if it continues to remain in business by charging people money for cell phone service. So that's part of the reason why businesses charge a higher interest rate than governments do. Okay. But the challenge is this is not true in an area like European Union, even though everybody has the same currency. In the United States, it's true that U.S. government is able to borrow at the lowest interest rate out there, but in Eurozone, these interest rates charged by various governments started to diverge during the financial crisis because people started to realize two things, right? People started to realize that some of the countries could actually go bankrupt and they could actually not pay their loans back, especially countries like the distressed countries I mentioned: Italy, Spain, Portugal, Greece, Slovenia, and so on. So think about it this way, right? If you have money to invest in a bond, would you rather own German bonds or would you rather own Italian bonds at the heart of the financial crisis? The answer is always going to be German bonds because German bonds are considered safer. So as a result, because of this answer, Germany has the luxury of offering you low interest rates, or put differently, Greece is forced to entice you by charging you a higher interest by offering you a higher interest rate. The differences between German and Greek interest rates is called the risk premium, right? So the risk premium started to show up in the aftermath of the financial crisis. And the second thing that happened, and this is extremely important, is a lot of people started thinking that there is some redenomination risk. So what does redenomination risk mean? We spoke about the interest rate parity condition, which says interest rate in one country is equal to is equal to interest rate in another country, we'll call it country B, plus percentage change, excuse me, in future exchange and expected exchange rate, right? So, but if you adopt the euro, then we discussed this. This becomes zero. So by definition, interest rate in two countries should be the same. However, exchange rate risk was at play again because people thought not only are these people going to borrow a ton of money in euros, eventually a country like Greece is going to leave the European Union, and then you're going to have to incorporate the expected depreciation into your calculation, while identifying what interest rate you want. So this causes divergence, right? So in other words, let me put it this way. So I mentioned before with the universal currency, this is equal to zero, right? So this cancels out and I star equals B star. But if this is greater than zero, well, guess what? Then I star by definition becomes greater than the exchange rate in the other country, right? I star by definition becomes greater than the exchange rate in the other country. So this shows how the divergence in interest rates occur. Okay, let's look at a picture to tell the same story differently. Okay, so here's exactly what I'm trying to share with you. If you look at the two curves on this chart, starting in January 1990 to 2012 ish, or maybe a little more, maybe 2013. And so the black curve shows the difference between the lowest interest rate and the highest interest rate in the European Union. Okay, lowest interest rate and the highest interest rate in the European Union. So if you were to say that Greece was able to get away with charging 0% in 1999, or not Greece, Germany, I mean. And then you were to say a small country like Cyprus, on the other hand, had to charge 7%, well, that's what would have created the gap, okay? So that's what would have created this gap, okay? And the blue curve, on the other hand, is the average interest rate charged by an average country in the eurozone. So just to clarify, what this basically means is if the average rate was 11% here, then Germany was able to borrow at 11%, which is the average interest rate, and Cyprus, by definition, had to borrow at about 17%. Okay, so you get 11 plus 7 is about 18. Okay, so that's basically this chart. I'm going to clean this up a little bit. But if you look at what has happened, the pattern here is here's where the European Union adopts the single currency, right? And I didn't do a good job here, but what I meant to say is about here. And you see how the average min-max range started declining. In fact, it became close to zero, which means there's pretty much no difference between Greece borrowing or Germany borrowing at the on the eve of the adoption of euro, and that remained the case until 2008. In the aftermath of the financial crisis, look at this gap. Germany could borrow, if the average rate here was what, 5%, Germany, let's say, could borrow at 5%. If this was the German rate, this, so at 5%, this by definition would mean Greece had to pay a premium of 14%, so you get 19% here. Greece had to borrow at 19%. You see the difference? Even though they had the same currency. So this is exactly what we spoke about earlier, except in word instead of chart. It's always nice to see the data follows everything you discuss. So that's what happened to the bond markets. Let's talk about the stock markets. This chart is not in your textbook, but it's always interesting to look at different data points. I got this from European Central Bank's website, but basically the differences in shares or return on share equity holdings. So that'd be like if you own stocks in the European stock market. The differences in returns between the distressed countries and the non-distressed countries became significantly more dispersed as a result of the financial crisis. Let's look at the chart. Left to right is basically the returns from median or average return, median returns of owning equities in the European countries. So the blue line is median return. So this 0.002 is 2%, this is 4%, and so on. Okay. So as you can see, median returns are pretty low for most countries. Now, mind you, median returns basically means 50% of the countries offered more returns on stock holdings and 50% offered less. And this can be thought of in the sense of interquartile range, right? So you could see that 75% of the of European countries offered a return of less than 3%, and basically 50% of so this gap here is 50%. Basically 50% of the European stock markets offered a return of between 1% to 3%. Okay, and if you look at the lowest and the highest, you see some noise here, right? The lowest return in all of Europe was less than 1% in 1995, and it was nearly 7%. The highest return was nearly 7%. So that sort of sets up the graph on how to look at the median, interquartile range, and min-max range, and how they communicate with one another. So as you could see, after the adoption of euro, which was right here, this gap, the min-max gap, started to shrink, right? There was more consistency in the returns you could earn across the European Union, no matter which stock market you invested in. I mean, think about it, right? Like from the highest of 7 to the lowest of 1 to the lowest of, say, 1 to the highest of 3%, right? And in this case, it's even smaller, right? The gap in no matter where you invested was pretty much identical in the European Union. But look at what happened in the aftermath of financial crisis, which is right here. This period. And this is pretty interesting because you can see some of the impact of coronavirus as well about here and here if this goes up to 2020, which I think it kind of sort of does, or maybe it doesn't. Anyway, let's focus on the financial crisis. Look at the min-max range. If you invested your money in the lowest earning stock market in the European Union to the highest earning stock market in the European Union, the differential is over 11%. The differential is over 11%. You could earn the highest stock market returns were 11%, and the lowest were nearly 0%. In the European Union. And if you look at the median too, as a result, the median was also pushed out, right? Here's where 50% of the stock markets offered less returns and 50% offered more returns than this point, which is about 4%, right? Now let's look at the interquartile range, which let's see if you were to take out the noisy outliers, which would be the bottom 25% and the top 25%, the middle 50% provided these types of returns in the aftermath of the financial crisis. And that really did not go away because after the financial crisis, you had the sovereign debt crisis, right? Where you had issues with all these countries like Greece having too much debt in their balance sheets. Okay, so this is a pretty cool chart, not in your textbook, but it helps us tell a story. And the story is that there was significant defragmentation in pretty much all financial markets, or there's significant fragmentation, de-integration in all financial markets. We talked about the stock markets, we talked about the bond markets as well, as a result of the financial crisis, okay? And we talked about the banks. Let's now talk about the monetary conditions in Eurozone countries. Okay. So, so the way credit is provided in the European Union is different across Eurozone. Okay. And the way monetary policy is designed to influence the way credit is provided is also different. And we've spoken about this in prior chapters. Specifically, I'm talking about in the presence of asymmetric shock, common monetary policy is not appropriate for all members. Remember, we spoke about the diagram where centralized policy making for what was it, transportation service between a rural area and an urban area may not be optimal because the rural area may end up getting too much transportation and the urban area may end up getting too little transportation. Similarly, here as well, a monetary policy at a centralized place may not be optimal for the eurozone because asymmetric shocks may mean that the policy is too loose in some countries, too lax, or too tight for the other countries. Right, too lax for one group and too tight for the other group. Okay, so let's talk about in the aftermath of financial crisis what happened. Well, what immediately happened was European Central Bank did cut the interest rate, right? But it did not necessarily, as expected, have the desired effect. Why did it not have the desired effect? Because by the time it cut the interest rate, countries that were less affected, like Germany, the decline in interest rate took hold, and German interest rates went down exactly when they should not have gone down. Right, so it stoked inflation, or it had the potential of stoking inflation in Germany. Whereas in Greece, people realize Greece is kind of decoupled from the European Union, and therefore any moves by the European Central Bank is not going to calm the investors that are invested in Greece. So what ended up happening, especially remember we spoke about the denomination risk. People realize that it doesn't matter what the European Central Bank does because they feared that Greece may just borrow all this money and then leave the European Union, and now they have to take into account the exchange rate influences on Greece's interest rate. So it didn't matter what European Central Bank did; it wasn't enough for Greece. Okay, and let's look at evidence. Right, basically, what all this means is centralized monetary policy broke down exactly when it was most needed. Okay, and let's look at the evidence. Here's the evidence. So your book has the European Central Bank interest rates. I was not able to incorporate that in the chart, but it's an interesting thing to keep in mind. Basically, you can see here there in 1999 when the euro was adopted, about here, there's a convergence in various interest rates from all these other countries, right, into a single interest rate, and that glorious period called the period of great moderation, unfortunately, did not last too long. It lasted pretty much after the dot-com bubble. It started and it ended after the financial crisis. Look at what has happened to the differences in 10-year interest rates for bonds issued by various governments. Red is Greece. Greece at some point had to pay 30% interest on its borrowings. At the same time, you had light blue, which is Germany, was still paying less than 2% on its borrowings. So look at the risk differential or the risk premium between the two bonds, right? If a person bought a Greek bond versus a German bond, the difference in the interest rates would essentially result in nearly a 28% risk premium, 27% risk premium, right? This is all a risk premium. Okay. So that was the impact of financial crisis through fragmentation in the various components. Let's talk about the Eurozone and its banks. This is the final section in this chapter. We'll skip 18.5, but 18.4 is pretty important. So we start this chapter out by talking about the characteristics of financial markets, and we spoke about scale economies, networks, and information asymmetry. Let's give it another thought with regards to specifically the Eurozone and the banks that reside within the Eurozone. So we spoke about how scale economies basically means banks can do what they do, which is accept deposits and lend money because they do it at a large volume. But that also means, in the grand scheme of things, very few banks will eventually come to dominate the banking world. In the US, JP Morgan Chase, Bank of America, Wells Fargo, and Citibank, the four banks, pretty much represent a good 50% of the banking world in the US. In the European Union too, we are seeing similar trends where, remember, on the eve of the or on the eve of the adoption of euro, there were 8,300 banks, and right before the financial crisis in June of 2008, they were left with a little more than 5,000 banks. So why is this happening? Because there's monstrous consolidation happening in the banking industry. It happens because banks can only function if they continue to maintain volume, right? But what does that mean? Well, that also means that few large banks will eventually dominate the financial market and the banking world. But on the other hand, it equally means that various economies are vulnerable and are held hostage at the hands of just one of few banks. And we saw that in financial crisis, where we had to bail out all these banks because we recognize that we have 4 or 5 extremely important banks that we can't let them fail. Okay. The second characteristic of a financial market, and another look at it, is that banks are usually a part of network. What that means is, as I mentioned before, they're usually dealing with each other on an ongoing basis. We gave you the example of the $30,000 savings that you wanted to make for 3 years versus somebody else having to borrow that money as well, and how banks deal with each other with regards to the $30,000 you deposited. So how banks deal with other banks in their same network. But what the other side of the coin of this characteristic is that if one bank fails, what ends up happening is it affects other banks as well. Let's go on with that $30,000 example where you deposited it in a savings account in your bank. Your bank does not have any borrower who wants that $30,000 or wants to borrow that $30,000. So it turns around and it lends it to another bank who actually has a borrower waiting in the wings. But when it lends the money to that other bank, and if that other bank fails, well, it's not going to return the money to your bank, and in turn, theoretically, your bank is not going to return the money to you, even though it's no fault of yours. All you did was deposit the money. So the other side of the coin with the networks characteristics of the financial market is they're all interconnected, and virtually all large banks end up becoming systematically important, and one bank's misfortune can pretty much drag down the entire banking system. The final characteristics of financial market is information asymmetries, which, as we discussed before, it basically means borrowers tend to know more about their willingness and ability to pay than banks could. And the other side of that coin is that banks routinely take large risks by lending money to all kinds of borrowers. But the other challenge is also these borrowers sometimes are other banks. So what ends up happening is most banks don't necessarily know how healthy the other bank is. And so in a situation like financial crisis, where we spoke about interbank markets freezing, interbank lending freezing, this is exactly what happens. Information asymmetry does not only affect a specific type of borrower, it affects all borrowers. In that, if the borrower is also a bank, the bank that's the lender is not going to trust the borrowing bank's ability to repay the loan it is about to make. Okay. So aside from these characteristics, what ends up happening is, in the grand scheme of things, people make their life savings and they put it inside of banks. And so you can't just unlike any other business, you can't just let a bank go bankrupt, because the saver would be like, hey, this is no fault of mine. I didn't take any risk. It's the bank that lent my money, right? So the banks end up becoming systematically important, and the states are required, therefore, to protect people's deposits and their banks. The problem with this is if I'm a bank and I know that my deposits are insured in the US by the Federal Deposit Insurance Corporation, then it incentivizes me to take excessive risk, which I would not have if I was playing with my own money. Since I'm playing with depositors' money, I can just go ahead and take excessive risks. So it creates a moral hazard issue as well. Okay. So, to deal with these three or four things we spoke about, specifically, we spoke about the network characteristics, scale economies, and information asymmetry. There are four or five things in place in all developed banking industries in the world. So specifically, I'm talking about regulation, supervision, and resolution. So over the next few minutes, we're gonna dig deeper into each of these three areas, and we're gonna talk about how European Union or the Eurozone does all of these three things. So, to reduce the consequences of catastrophic events, governments develop what's called regulations or rules within which all banks should play by, or with which all banks should abide, right? But there's a problem with regulation, right? Just like a stop sign that says you need to stop here before you continue going while driving, you need some sort of supervision. Every once in a while, a cop has to hand out a ticket to someone who rolls through the stop sign instead of fully stopping, partially because in and of itself, regulations are not adequate. People, if nobody's looking, people are just gonna not obey the regulation, and it's gonna create a havoc in terms of driving. It's gonna create accidents, and people are gonna unfortunately die through car accidents. And in the banking system, just developing regulations and not supervising the regulated is gonna create a problem with the regulations not being followed. It's kind of similar to, once again, IRS or the tax department as well. Yes, there are laws that require you to pay taxes, but the only reason you and I really pay taxes is because we fear that we're going to get audited if we didn't do that. Okay. So as I mentioned before, it's not enough to adopt good rules. It's really essential that they're to make sure that they're respected. And another thing to keep in mind is since financial conditions can quickly deteriorate, supervision must be continuous and to an extent unpredictable, in the sense that if banks know that there are rules in place, and if banks know that once a quarter you're going to go ahead and make sure that the bank complies with those rules, well, all the troublemaking happens between two of your examinations when you do actually try and examine whether the bank is complying with those two rules. So in some ways, supervision has to be continuous. Put differently, while you're driving and there's a stop sign, if you realize that the cop only shows up to that stop sign every Saturday at noon, that's the only time you're really gonna stop. Every other time, you're gonna keep rolling through the stop sign without really stopping. Similarly, with IRS, if you realize that IRS only audited income tax returns of those people who made over $1 million, you're just going to pretty much make all kinds of claims on your income tax returns to get maximum refund and pretty much pay no taxes at all. So that's why supervision has to be continuous, it has to be random, and it has to be unpredictable. Okay? So even with perfect supervision and regulation, the third point to be made here is there always will be bank failure. Supervision and regulation does not stop serious fraud, right? And let me give you an example. You can have all the regulations in the world, but the truth is, if there are employees in the banks that just literally physically want to steal money, well, there's no supervision and no regulation that's going to stop that from happening. So banks will fail, right? And so for banks to, but as we mentioned before, banks are important in that they can't just fail. They literally have savers' monies and depositors' monies that they're accountable for. So if they fail, all the savers and all the depositors, through no fault of their own, lose all the money they had saved or deposited in that bank. So just supervision and just regulation is not enough. there needs to be some sort of a resolution authority as well. And by resolution, what I essentially mean is orderly liquidation of a bank that has failed. So that authority in the US is with the Federal Deposit Insurance Corporation. Okay, so now let's dig a little bit deeper into how the European Union does it. As far as the regulations are concerned, rules that govern the banking system are now, since the implementation of single currency and the Eurozone, are designed at the EU level primarily because of the four principal freedoms of the European Union, right? Which is free movements of capital, people, and workers, and goods and services. So as a result, if you do indeed want free movement of capital, then the rules have to be designed centrally. And the challenge also is if national rules, if the rules were designed nationally, and they differed significantly, then it in some ways, not deliberately, but it hinders free movement of capital, right? Like if national rules make banking system overly restrictive in one country and overly lax in another country, then all the corporations are gonna and individuals are gonna run to open bank accounts in the overly lax country. Especially if you're doing something illegal, then you might want to go to an overly lax country and open a bank account. So these banking rules are designed at a central level. Okay. Second is supervision. So the argument for supervision at of keeping supervision at a national level is something that we have addressed before. It has to do with the fact that local governments are better at knowing local informations. Bottom line, local governments are better at keeping in check information asymmetry. European Central Bank, for example, is based out of Frankfurt, Germany. How is it gonna know the local conditions in Italy or in France or in Portugal? So supervision function, which is which is examining banks to ensure that the banks are following European Central Bank rules, should be theoretically left at the subnational level. So that'd be at with each country. The second piece is unless supervision is deemed ineffective or inefficient at the national level, it should remain at the national level. And this is something that we spoke about before. Specifically, this talks about the principle. This is in compliance with the principle of subsidiarity, where don't centralize things unless it is those things being done locally have proven ineffective. Okay. So one challenge with centralized supervision is that banks may end up becoming one argument for centralized supervision as opposed to subnational supervision is that banks may end up becoming multinational because, as I mentioned before, banks are in the business of accepting deposits and making loans in volume, so they can take advantage of scale economies, and therefore you want a lot more consolidation and you want banks to become multinational. Well, if the banks become multinational, which is essentially the point of single market, then you want centralized supervision, right? Because how is an Italian government employee or Italian central bank employee going to govern a huge bank like BNP Paribas, which is a multinational French bank with branches in all countries, including the U.S., in all European countries, including the U.S. Of course, U.S. is not a European country, but BNP Paribas does business in the U.S. as well, is what I meant to say. Okay, so that's the point of the single market, and central supervision will make it easier for banks to comply. But then there's a problem with that. To be honest with you, the U.S. is a little bit affected by is the problem of revolving door, where you would have government employees go easy on banks as far as supervision function is concerned, so that they can get a job with the banks, and then the bank employees would be more would benefit from working in the government, for example, and therefore they develop a relationship with with their government counterparts. Right, so that's a challenge with centralized supervision. And finally, the benefit, or that's a challenge with localized supervision, where local central bank employees are more likely to quote unquote be in bed with their banks so that they can get jobs with these banks. Centralized supervision will get rid of that. Finally, you want equal and level playing field for all banks as far as supervision function is concerned. And what ends up happening is, say for example, you're an Italian regulator, chances are you're going to go easy on your own Italian banks, and you're going to go harsher on foreign banks such as Santander or BNP Paribas or something like that. Okay, so centralized supervision um, will allow for all of these nuances to go away, and there would be level playing field for all banks, irrespective of which country you're headquartered in. Okay. Oh, of course, one more important point is, if you're a monstrous bank like a JP Morgan Chase, except the European equivalent, then a small country is not going to have the firepower to deal with it during a crisis situation, especially in terms of bailout. So, someone like ECB, European Central Bank, is more equipped with the tools to bail out a very large bank. So, that's another argument for centralized supervision. Finally, the resolution authority. So when a bank fails, its supervisor must figure out who must be protected and who must be not protected. And this generally means some people lose money, some people gain money, and historically it has been depositors who, well, some people don't gain, nobody gains money, but some people are made whole, whereas some people lose money. So depositors are usually protected and they're made whole, and owners of the banks are usually the ones that go bankrupt when a bank fails. So this basically calls for delegation of this resolution authority at the national level, not necessarily the central level. Why? Because optics, right? Like, you want the national, you don't want it to look like a centralized, gigantic government mechanism is coming in a small town in Italy to close a small bank. It just doesn't look good, right? So, from an optics perspective, you want the resolution authority to be with national central banks. However, there's a problem with this. The problem is that banks are very powerful in all countries because they recognize, we talked about the moral hazard problem, they recognize that they are the heart of the economy. Without banks, economies come to a standstill. So they recognize that, and therefore they exercise strong influence over their own governments, right? As a result, if the resolution authority is with the national level, then they're gonna want their governments to use taxpayer money to bail them out, right? And the second thing is, many governments recognize the importance of banks, and therefore they also tend to protect their own banks, which is not in the spirit of single market. So in that sense, these two reasons justify the need for centralized resolution authority. Okay. So the financial crisis made pretty much a strong case, and of course the debt crisis, sovereign debt crisis that followed, pretty much made a strong case for centralized regulation and centralized resolution authority, and to a great extent centralized supervision authority as well. So basically, when the euro was created in 1999, this is way before the financial crisis, the basic solution was to establish some minimum regulation at the central level with decentralized supervision, and then decentralized resolution authority as well. So both of those functions were done at the national level. But the financial crisis changed everything. What specifically I'm talking about is Ireland's decision to provide unlimited insurance to all of its deposits and other liabilities. And this caused, and so why did this happen? Well, this happened because a lot of influential industries that are not, well, a lot of influential industries had their monies deposited in Ireland, and they pretty much were in bed with the Irish government, and they wanted to protect their own money. But this implied that Ireland had to borrow a ton of money. it had to basically borrow in excess of 30% of its GDP. Well, the problem is when one country in the Eurozone offers, as I mentioned before, unlimited insurance and others don't, everybody looks at that country and banks in those countries with envy. And if you're a depositor in any other country but Ireland, you want a bank account in Ireland, partially because you want unlimited insurance. You want your deposits to be protected, especially if you're a millionaire, billionaire, zillionaire, right? You don't want to you want to move all your money from France to Ireland because pretty much all of your money is protected, right? So as a result, many other countries were forced to make that concession as well. They were forced in turn to provide unlimited deposit insurance to their banks as well. This caused a lot of countries to borrow a ton of money because to provide insurance and protection, you need to have that level of liquidity, right? You can't just say I'm gonna if $100 billion bank a bank that has $100 billion in deposits fails, you need to have $100 billion to make the depositors whole. So if you did have the $100 billion, your only solution as a country is to borrow all that money, right? So as a result, a lot of countries borrowed a ton of money, and once dust settled down, people realized that all three functions, regulation, supervision, and resolution, has to happen at some sort of a centralized level, and this resulted in the creation of European system of financial supervision and the banking union. Okay? So what is the banking union? So central banks are involved in banking and finance partially because not partially, to a great extent, monetary policy flows through the financial markets and through the banks. Remember we spoke about how in the US, when the Federal Reserve decides to flush the US economy with cash or take cash away from the economy, it does it through these intermediaries that are about 10 to 13 global banks. And so it basically buys and sells securities directly to these banks for billions and billions of dollars. That's how the monetary policy is executed in the US. And that is also the case in Europe as well. But the Maastricht Treaty did care about the fact that central banks are involved in banking and finance, and therefore it should be the monetary policy function should be kept at the subnational level. Instead, the Maastricht Treaty gave the delegation of monetary policy making to the European Central Bank, and this was considered back then a huge loss of national sovereignty. Right? People like to control things as a sign of national sovereignty, and one of them is being able to control monetary policy. So when countries started losing control of their monetary policy, giving up supervision and resolution was not palatable for many countries because they felt like they were losing control of their own banking sector, which, as I mentioned before, is economically very important because monetary policy and all business is done through the banking system, irrespective of what industry you are in. As a result, however, this was an unwise decision, and the cost had to be paid during the sovereign debt crisis because all the national central banks ended up borrowing too much money to provide unlimited deposit insurance. So since then, the core functions of regulation, supervision, resolution has changed, and they have been handed over to the European Union to a great extent. Here's the kicker, though. In the U.S., each of the 50 states have financial regulatory authorities, and there are two groups of banks in the U.S. There are state member banks and the state non-member banks. So basically, you could be a state non-member bank, and you could be regulated by a national regulator like the Office of the Comptroller of Currency, or you could be a state member bank, and your primary regulator ends up becoming your state government. So the U.S. has somehow done okay with this sort of dual regulatory authority, and it's just unusual that Europe is not able to do that, partially maybe because we have just had this authority for so long, this dual regulatory authority, that we have ironed out all the creases, versus Europe's monetary union itself is so new that they're still trying to figure things out, and maybe centralization is the way to go. Anyway, I digress. So let's go back and talk about what regulations the European Union have adopted. And this is part of the reason why I'm skipping 18.5, because it gets into nitty gritty. But these are the basic things you should always keep in mind with regards to very basic and very important bank regulations that apply to pretty much banks in Europe, but also identical regulations apply to banks in the US. So in 2013, the European Union adopted Basel III measures. So I know I mentioned Basel. Basel is a Basel committee is a committee formed made up of, I think, about 60 central banks of the world, and they put together various criterias by which to evaluate safety and soundness of their local banks. Partially, this is especially important in this day and age because people realize that banks are generally very globalized, in that a bank in the US failing would cause a lot of banks in Europe to fail as well. So they've put together these universal rules for all the banks, or at least of the Basel Committee membership banks, to follow. Rule number one is bank capital. So all banks are expected in Europe, and this is true in the US as well, are expected to have as much as 8%. Well, all banks are expected to have the amount of capital that is equal to 8% of risk-weighted assets. So now I know this gets technical, but what does risk-weighted assets mean? Well, after the financial crisis, people realized not all assets are made equally. In other words, theoretically, if I'm a bank, if I had cash in my hands versus me lending money to a John Doe to buy a house for 30 years is also an asset, right? So me having $100,000 in cash is the same as, theoretically, the same as the $100,000 I lent to John Doe. Why is it the same? Because John Doe is eventually going to pay that back to me, right? So that's an asset. The problem is, after the financial crisis, regulators realized, well, those are not really two equal assets. Of course, the loan given out to John Doe is significantly more risky, so you have to risk weight it accordingly. The cash in hand is not at all risky because cash is cash. And so you don't need to risk weight that at all. So now when I say risk weight, what does that really mean? Or for that matter, what does even capital mean? Capital is basically a buffer you need to carry to make sure that if John Doe stops paying his bills, then you have enough cushion to still pay the depositors. So that money would come out from your capital account. Okay. So if depositors deposit money, you lend it to John Doe. John Doe doesn't pay his bills. Well, you still need to pay the depositor. Where is that going to come from? It's going to come from the capital account. So think about it this way. For every $100 in highly risky assets, a bank is expected to have 8% of capital. So if say you gave out 12 or 13 such loans to John Doe's and one of them didn't pay, you would pretty much use up your entire capital to make the depositor whole. Anyway, so that's the risk-weighted capital requirement. Okay. Leverage ratio is something that we learned about even right after in the aftermath of the financial crisis. What we learned is basically if the cost of borrowing is lower than the returns on investment, then the bank makes money. So it creates an inherent incentive for banks to borrow money, right? Because what it's going to do, as I mentioned before with that $30,000 savings deposit example, is it's going to borrow from one person and take that cash and then lend it to somebody else, and it's going to make money in the middle by charging a higher interest rate to whom it is lending, right? And so banks are incentivized to borrow. But we learned in the financial crisis that part of the reason, not part, 100% of the reason why Lehman Brothers failed is because it borrowed way too much more money than it could pay back, right? So in order to reduce risk taking in the form of borrowing excessive money, Uh, each bank was tasked with having a specific leverage ratio. So the leverage ratio was monitored by the regulators, and basically, regulators can require that banks reduce its leverage ratio and borrow less money. Okay, I think it's about 10%. Leverage ratio is about 10%. Bank can't borrow more than 10% of its assets, I think. Liquidity ratio is important as well. So the liquidity ratio is basic. What is liquidity? Liquidity is basically a composition of all assets that can be quickly gotten rid of to obtain cash as a proportion of the payments that the bank expects to make over the next 30 days, 60 days, 1 year, whatever the case may be, right? Basically, what it's saying is if you deposited that $30,000 in your savings bank, fast forward 3 years later, you say, you know what, I want my $30,000 bank. The bank can't just turn around and say, oh, wait, I gave that money away. I lent that money for 30 years to John Doe, so I can't give you your $30,000 back. The bank is expected to have that $30,000 in liquidity because it knows you're going to come asking for that money in 3 years. So in 3 years, the bank is expected to have that $30,000 in cash, and that cash is called liquidity. Okay, so the ratio will have to be progressively increased to 100% of what it expects to leave in the next 30 days. So in other words, if the bank expects in the next 30 days your $30,000 and somebody else's $30,000 and so on and so forth, and the bank expects $10 million in withdrawal requests in the next 30 days, well, the new regulations require that the bank have those $10 million in its account 30 days before they're expected to be withdrawn. Okay. But here's the kicker. Think about this for a second. In 2015, the bank was only expected, with regulation, to have 60% of that money. Think about that. Only 60% of 30 million of $10 million that were expected to be withdrawn over the next 30 days were expected to be in the bank's kitty, which is crazy because that's after the financial crisis. Can you imagine how little money the bank really had in the financial crisis or during the financial crisis uh, to pay you back when you ask for your deposits back? Okay, so that's regulations. Let's talk about supervision. So, in as of late 2014, European Central Bank identified 134 largest banks in the eurozone and basically centralized the supervision authority under the ECB umbrella. And this authority is called the single supervision mechanism. They realize really small banks are important to serve a local community, but the large banks is where the meat and potatoes are, and therefore the large banks should be regulated at the central level. This is true in the US too. If you are one of the largest banks in the US, which would be JP Morgan Chase, Bank of America, Citibank, and Wells Fargo, or even US Bank Corp, PNC Financial, and KeyCorp, then you're usually regulated by a bevy of regulators, specifically your holding company, because most of these banks have many banks within their structure, is regulated by the Federal Reserve. If you provide deposit insurance, which all of these banks do, then you're regulated also by the FDIC. But because you are a national charter bank, which means you've decided that you're not going to get the permission of 50 each of the 50 states to get each of the 50 states to do business in their states. You're instead going to go with one national charter. Then you're also regulated by Office of the Comptroller of the Currency. So think about it. In the US, if you're a large bank, you're regulated by 3 different supervisors. And in the European Union, if you're a large bank, you're now regulated by one monstrous supervisor called the European Central Bank. Okay. So the non-Eurozone countries can also choose to join SSM. Specifically, it's not like, countries in Africa can join the single supervision mechanism. It's specifically designed to enroll those countries where that are expected to become members of the European Union in the near future. Okay, so remember how European Union expanded from what 12 or 13 countries in up to 2005 to 10 new countries. So that made it 27. So I think it had 17 and then it went to 27 after 2005 with the entrance of Poland and the former many of the former Yugoslavian countries into the European Union. So this mechanism is meant for really that type of a scenario. Okay. Finally, the problem with centralized supervision is that the critics worry that the European Central Bank faces a conflict of interest between its monetary policy making authority and bank supervision duties because it may be too relaxed with its monetary policy because it realizes that it can always keep an eye on the bank through its supervision function. It's true in the U.S. as well. Federal Reserve does the monetary policy and also supervises banks, but I don't. It's not that big of a concern. I don't think its monetary policy is influenced by its supervision authority. So I imagine that's not also the case in the European Union. Finally, if the European Central Bank makes a wrong judgment call with one of the 134 banks it regulates, then the problem is their credibility and their independence is going to be questioned immediately by various countries. So in the U.S., the big brouhaha several years after the financial crisis was, why did we ever bail out large banks instead of bailing out people who are affected by it, right? And so the central bank lost a lot of credibility, and its independence was also questioned in the aftermath of the financial crisis, and people feared the same would happen with the European Central Bank. Okay. Finally, the resolution authority. So Bank Resolution Authority has also been transformed specifically because high risk-taking banks before the financial crisis were able to convince the governments to take on excessive debt levels so that they could bail those banks out. And because the European Central Bank realized that this is a problem, they have centralized the resolution authority. So how did they do this? Well, in parallel with the single supervision mechanism, they put together a single resolution mechanism as well. So what are the features of single resolution mechanism? Is that the resolution of a bank will be decided by the single resolution board, but it will be carried out by the relevant national resolution authority. So the centralized single resolution board is going to say this bank should fail, and it's going to give the advice to, say, if it's an Italian bank, to the Italian bank regulator, and then that Italian bank regulator is going to perform an orderly liquidation of that bank in Italy. Okay, and the funding for any cash injection for in instances where a bank cannot meet all of the requirements, all of the depositors' withdrawal requirements. So funding for those will be provided by this resolution fund, and that fund in turn will be funded by contributions from these 134 largest banks that will be made between 2016 and 2024. European Central Bank has kept distance from the supervisory resolution mechanism because it believes that supervision and resolution should be separated. And it kind of makes sense. You don't want an entity that oversees your that oversees safety and soundness in your bank to decide that your bank should essentially liquidate. I think that becomes a little bit muddy because it makes the central bank too powerful. Basically saying, you know what, if you don't comply by our orders, we'll just close your bank. You don't want that to happen. So optics don't look good. So European Central Bank keeps away from the SRM or the supervisory resolution mechanism. Finally, the creation of the SRM is also complemented by the directive to minimize cost to taxpayers by creating a pecking order for bank losses. What does that mean? And this is true in the US as well, because it has been true since 1933 when the Federal Deposit Insurance Corporation was created. What does this really mean? If a bank goes out of business, then the first people to pay the cost of going out of business should be the shareholders. if you have an ownership stake in the bank, you should lose your money, because by definition, when you bought stocks in that bank, you recognize that it comes with high risks and high returns. And the last person to lose money in a bank transaction, and this never happens basically because they don't lose money, is depositors. If you are a depositor, you did not deposit money in a bank knowing that this is high risk, high return. You're pretty much getting low returns because you're saying, I don't want to buy stocks. Instead, I'm going to open a savings account. So that's basically is the directive to the SRM as well. Okay, so that brings us to the end of chapter 18.